the investment banker who is going to help them get all the documents ready, determine a share price, market and sell the shares, and also if some shares are unsold, Pangea Securities can buy those shares, which is called underwriting. Okay. So we are on part C of this question, which is saying using a capital asset pricing model, calculate the required rate of return for ZEC shares. Then the next part, based on this required return and the offer price of 5 kwacha, would you recommend that the investors subscribe to this IPO? Justify your answer using the concept of the security market line. Okay, so first things first, the capital asset pricing model. What it tells us in simple words, colleagues, the higher the risk, the higher the return. Okay? Higher the risk, let me put it here. The higher the risk, the higher the return. Okay. So here, based from what I'm saying here, this is the return, required rate of return here, and this is the risk here, beta, which measures systematic risk. Okay. If this beta increases, okay, if this beta goes up, okay, risk-free rate will usually stay the same, market return also, they'll both be fixed usually. Okay, might change year to year, but on average they'll be fixed. Okay, but if this beta goes up, what happens is this required rate of return has to go up. If this beta goes down, the required return also is going to go down. Okay, that's what the capital asset pricing model is. Alright, so we already calculated the required rate of return. Here's the tabulation again. Okay, in the question they told us risk-free rate, let's get this information here. They told us risk-free rate 12%, expected market return 18%, beta 1.3. Okay, so this is the information we need to get our required rate of return. And here's the tabulation here. Okay. Required rate of return 12%, beta 1.3, market return 18%, risk-free rate 12%. Subtract these two, you get 6%. 6% times 1.3, you get 7.8%. 7.8% plus 12, 19.8%. Okay? That's the first part of the question here. Okay? The required rate of return is 19.8% using the capital asset pricing model. Any questions before I go further?
No, I want to find out. Maybe I'm a bit behind, and I can't even display the question. The beta, the 1.3. How did you find it?
It's given in the question, madam.
It's given?
It's
Okay.
given. This one here. As I said, all these values are given, so it's just a matter of putting in the formulas. Okay, any questions before I move? Any other questions? Okay, so because here we're using the security market line to determine if the shares are overvalued and undervalued. Okay, so first we calculate the expected required rate of return using the capital asset pricing model. Okay, we got 19.8%. Now we're going to get the expected return using the dividend discount model. Okay, colleagues? We're going to get the expected required rate of return using the discount model. Okay, so let me just show you how we do that. So if you remember, the formula for the dividend discount model is PO equals D1 over KE minus G. So here, colleagues, what we're just trying to do is we want to find KE. Okay, well, let me put it as RE since it's a required return. Okay, RE, KE, same thing. Okay, so just that KE is cost. Looking at the company side, RE, they look at the investor side. Okay, so here I want to find out this required rate of return based on the share price of 5 watch. Okay, this offer price, based on this offer price of 5 watch, what should be the expected return for someone who invests in this company? So to make RE the subject of the formula, this is how you do it. Because memorizing formulae is not good, colleagues. It's not good. Cross multiply first. Okay, cross multiply these two. And also cross multiply that. Okay, so you're going to have PO open brackets RE required rate of return minus G equals D1. Okay. So here you need to get rid of this PO, so we divide both sides here, divide by PO, divide by PO. We're going to have RE minus G equals D1 over PO. Okay, so we're making RE the subject of the formula, so this negative G is going to go this side. So RE is going to be D1 over PO, D1 over PO plus G. Okay, colleagues? Yes. So remember this, because when you look at the weighted average cost of capital topic, where you have to get the expected, the cost of equity, you can either use capital asset pricing model or you can use the discount, dividend discount model. Okay, so the dividend discount model, this is the formula. The cost of equity or the required rate of return equals D1 over PO plus G. So we've got all these values here. Okay, D1, remember D1, the expected return, we calculated it earlier on. Okay. Those of what now calculated that 0.21 with that here. Okay. we're getting D1, so it's the current dividend which was given to us. This 0.2 is that dividend per share in the question multiplied by 1 plus the growth rate. They told us the growth rate of the dividends is 5%. So 1.05 times 0.2 gets 0.21. Okay, so this is next year's dividend. 21. Okay, so that's our D1. Are we okay with that, colleagues? This is how we got our D1.
Good evening, sir.
Good evening, sir.
Yeah, please. Just a quick recap. I joined late, please.
We are doing question C for ZDC company and Pangaea Securities. So we're trying to see if the shares are overvalued or undervalued using the capital asset pricing model in the security market line. Okay, we want to find out, are the shares overvalued or undervalued using the security market line. Okay, so here what will be required is this. You need to first calculate the cost of equity, required rate of return using the capital asset pricing model, which we've calculated here, 19.8. Now, we want to find the required rate of return based on this 5-quarter offer price and this growth rate of 5% using the dividend discount model. So we're calculating two required rates of returns. Okay, we're calculating two of them. Is that okay, sir?
Yes, sir. Thank you.
And I'm recording, so you have chance to. You're going to have
Yeah, please. That's why I was coming to as well on the recording.
So 0.21 divided by 5. This 5% convert it into a decimal. Okay, so 0.21 divided by 5 you get 0.0042. 5% is as a decimal is 0.05. 0.05. 0.042 plus 0.05 you get 0.042. Okay, and when you convert this into a percentage, colleagues, according to the dividend discount model, okay, the required return that this person is supposed to, an investor is supposed to earn if they invest in ZDC is 9.4%. Okay, so we're now going to use the security market line. Okay, to see if this 9.4% is overvalued or undervalued. This return. Okay. Previously, we were using the prices to see if the shares were overvalued and undervalued. Now here we're using returns to see if they're overvalued and undervalued. Okay, colleagues? When using the security market line, SML, they are evaluating returns to see if it's overvalued or undervalued. Okay, so let me show you how this graph looks like. Okay, so here on the y-axis you have the expected return. On the x-axis, you're going to have beta. Risk-free rate, 12% here. Okay. When risk is 0, here remember beta here, so here what we're just comparing is risk. Beta measures risk and return here, okay? By evaluating risk and return to see if a share is undervalued or overvalued. Okay, colleagues? Yeah, just comparing risk and return. Okay, so when the risk is 0, risk-free rate, the return you're getting is 12%. Government securities, right? Then your line should go like this. Your line should go like that. Okay, meaning what is that's basically telling us is the more risk that you incur, the higher returns that you're going to get. Okay? So our measuring stick, now remember when you're using the capital asset pricing model, I mean the security market line. You're using the security market line to see if the share is undervalued or overvalued. Okay. Your benchmark is going to be the expected return from the capital asset pricing model. Okay. Our benchmark is going to be the expected return from the capital asset pricing model. Remember, with the capital asset pricing model, we said risk is 1.3. And you're getting a 19.8%. Okay, this will be your benchmark of comparison. Okay, colleagues? When you pay a 5 kwacha, you're incurring a risk of 1.3 to get 19.8%. Okay, this is our benchmark. Now, when we calculated our expected return using the dividend valuation model, our expected return was 9.4%. Which is even lower than the risk-free rate. Okay. So now, this is how we are going to this is the, basically this is the law that you must follow this, so that you know how to evaluate. When you incur a high risk for a low return, the share is overvalued. And when you incur a low risk basically what this is saying is this: anything below the security market line is undervalued. Okay, anything below, overvalued. Let me just get my bundles. Let me just recharge the bundles before I get kicked out. Yes, but anything under the security market line is overvalued. Why? Because you're paying a 5 kwacha to get a return of 9.4, but the risk is very high. Yes, you're paying a 5 kwacha to get a return of 9.4. So the return is very low for the high risk. Okay, your return is very low for the risk that you are incurring. So it means the amount you are paying for that share, the share is overvalued. Okay, you are supposed to pay something cheaper, basically. Okay. And if the value is above the security market line, this is undervalued. Above undervalued, below overvalued. Okay. So this 5 kwacha we're paying for this company here, okay, the return is too low for the risk. If the return is low, okay, even the risk should be lowered. The risk should be high. So this share, that's 5 kwacha, is overvalued. The share price is overvalued. Okay, because the return is lower than the risk. You needed a high risk or higher returns.